Good afternoon, everybody. It's September 27th. I'm Taylor Hudson, joined by Hugh McNaughton. Thanks for joining us for Sprague's latest market brief. So, Hugh, we're going to put up a slide of heating oil. It's titled A Wild Ride Recently, and it certainly has been. We've had a 25-cent range in flat pricing from as low as almost got down to the $3 level, all the way up to $3.27 at the height of what I've called Fed euphoria. There in the beginning of the month. And I guess my big question for you is we've been up, we've been down. When I took this slide, we were 2 cents higher than when we last spoke to our customers on Market Brief. What the heck's been going on?
Taylor, as the slide indicates, after the long, steady run-up from that June 29 $2.52 pricing low at the point through to the early part of through to August, and then a relatively flat market. Finally, the rally got new legs on the anticipated both Federal Reserve and European Central Bank expectations of stimulus programs, and there we are. There's your Fed euphoria.
Now let's get this straight. The market thinks Fed acts, makes money cheaper. Therefore, what's going to happen?
Any commodity that's denominated in dollars, like oil, will be an automatic beneficiary.
Well, is there anything else? Like, is the Fed prompting anything else by doing this stimulus?
Yes, there is. It's a double whammy. There's also the expectation that if it works, if these stimulus programs work, and maybe, to be gentle, the jury is still out on that. The fact is that economic growth will result, and demand, of course, will then increase. Demand for petroleum will increase as well.
So the market sits there before the Fed's announcement and figures, well, they're going to lower interest rates or do quantitative easing. Things are going to get better. Once they do it, oh, wow, watch out. Demand's just going to spike. Everything's great. I pointed out on the slide here, the actual announcement came on a day when pretty close to the high that we saw for the month. So if the Fed actually announced they were going to do something, why the crash?
Well, it's the old seeds of its own destruction, I think, syndrome, where the higher the price, the more likely there will be a correction. And there had been all along, especially in the Fed euphoria period, those few days, increasing concern being manifested by people like the the International Agency, IEA, International Energy Agency, for that these prices could not be sustained without doing serious damage to obviously a very fragile global economy.
So would you say that was the sort of a big contributor to this massive move we saw? Middle of the month, September 17th, what I've labeled here is the flash crash day. We moved from 325 down to at 1.309, or one tick, I should say. What was behind that? Is that obviously something that had gone on while we were away?
Yeah, I think the analogy that occurs to me is a forest fire, a long period of drought. In this case, obviously, drought represented by steadily increasing prices over that week or two. And then something sets it off, whether it's a lightning strike in the middle of the night or some darn thing. The fact is that there apparently there's still a lot of investigation on this, but one large trading house, there was one large order to sell. It triggered an immediate implosion in the price, which was then exaggerated by the fact that so much of today's commodity market, is governed by so-called algorithmic trading, computerized, computers talking to each other is really what it boils down to.
So you mean all of a sudden I'm a computer and I see other computers selling, so I try to sell too?
That's correct. I mean, you're going beep, 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 and I'm going bop, 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 whatever it is. And basically you sell, I sell, and Joe's computer sells. And and then, of course, following on that is this so-called stop-loss phenomenon, which is where traders put in, automatic either sell stops or buy stops, depending on which way the market's going to protect themselves.
So if I'm a bull here, I'm watching the market go up, I'm getting nervous, I'm excited that the Fed announced, I'm getting nervous, but I'm sort of antsy that this might turn around. So I put an order to sell underneath where the market's trading, hoping to follow the market higher, but in case I'm wrong, I can get out early. You're saying those types of orders got hit as well once this big buy order came in?
Yes, I am, especially since, Taylor, doing that run-up, hedge funds increased their long positions, I mean, significantly to levels we hadn't seen, I think, since last May in the early part of that run-up then. So there was all your forest, there was all your undergrowth ready to ignite.
It seems like a lot of people trading positions that 1 minute, I guess, they're bullish, but 20 seconds from now, if the market changes, well, then they're bearish. They're going to get out.
Yeah, I think that's what's called volatility, and I think that's what's applicable.
So, okay, so we had the flash crash, and I remember that day very well. I happened to be looking at my screen, and first we were down 3 cents. Next thing you know, we're down 6, 7, 8, 9. It was pretty amazing. But a couple days after that, Hugh, we went down, we kind of revisited those lows, so it didn't look like this was an aberration at all. The market, closed down at 303 2 days after the flash crash. So, since then, we've kind of rallied back. What would you attribute the recent run up to the 315 range to?
I think it's a function of that same volatility. There was a very quickly developing sense that the flash crash and the subsequent 3 days you're showing there constituted an oversold market. It had come down too fast, too far, and that it was ripe for a correction. Whether the correction would have kept it going up or not is not clear. What has kept it going up, by the way, in my opinion, largely is all the posturing and going on at the UN General Assembly. Always a good place for posturing anyway, since that's a great place for politicians to get together. But especially, unfortunately, specifically between the West and Iran, and the West, of course, ably helped by Israel, over the whole concern about Iranian nuclear, problem weapons.
I'm watching CNBC lately, though, and they're showing pictures of rioting in Greece or Spain, concerns about China. I thought the Fed and the ECB fixed all this. I mean, do you think there are still significant doubts about economic health around the world, despite the fact that we've had this monetary or quantitative easing by central bankers around the world? So is that going to be with us still for a while?
We're such a bunch of lemmings when it comes to these market moves, and that Fed euphoria. There we all, basically we weren't jumping off a cliff. What we were doing, we're just following each other, saying, okay, this is it, this is wonderful. Now, all our worries are over. Blue skies are here again, overlooking the fact that all along, and even after that, economic reports indicate continuing deterioration. Just here recently, specifically with regard to Germany, which has been considered to be relatively immune, from the sort of Spanish-Greek type disease recently. But and maybe more significantly even than Germany is the fact that China is China is in a definite slowdown, and there are concerns that China may get worse.
So should I take you as a doubter that the headlines about poor economic growth going forward and their ability to push oil prices down has not passed yet? Or you think that we're still going to see some of those headlines?
I'm an optimist. I believe that prices have got a lot further to fall. There's a little bit of a switch for you. They're going to fall, unfortunately, as we have seen so much over these last couple of years. They're going to fall on the implications, on the rather bad implications of elements outside the price of oil, outside supply and demand. So
poor economic headlines.
Poor economic headlines, better oil prices.
Poorer 401ks. Thanks a lot, Hugh. Let's go to the next one, which the last 3 days has really been quite a story in the petroleum markets, and that's gasoline. Specifically, we've heard about Morgan Stanley running into shortages out of New Haven. We know inventories are tight. If you look at the chart here for gasoline, we actually entered the month around $2.95. We rallied the first part of the month as summer grade gas disappeared. We had basis differentials as high as 35 cents over the screen. Winter grade gas came into fashion mid-month. I'd say the market was driven more by the flash crash and sort of headlines for a week or two. And now the last 3 days we've gone from 290 up to 320. That's just on the NYMEX. We've got basis at 17 cents over. More of a where's the gas type discussion. So Hugh, can you provide any insight into what's going on with gasoline here at the end of September?
Yeah, I think we've had a little perfect storm of essentially the dislocations caused by the transformation from summer grade to winter grade, which ought to be in previous years has always been very smooth. It's just generally been almost unnoticeable. This year we had a significant shortfall in the summer grade to get us through to the expiration period. There's been a rather quiet development, shortage developing due to a number of refinery issues in the U.S., heavy-duty maintenance in Europe, which is a typical, very substantial supplier to the East Coast, maybe 1 million barrels or so a day on average. And here just recently, they turned a turnaround in Irving Oil's large St. John refinery. Somewhat unfortunately exacerbated by yesterday's explosion of no consequences at that refinery. But the bottom line is, here we are coming towards the end of a month, generally a period of pricing instability as traders and NYMEX holders, jockey to move their positions around so that they don't necessarily get caught in any kind of a end-month squeeze of one kind or another. And Taylor, I think that's what our problem is. It may be short-lived. I'm thinking it will be. None of these elements is really very long-lasting, but it sure is giving us this problem we're looking at now.
Let's talk about heating oil and basis real quick to wrap up this discussion. We presented this slide 2 market briefs ago. It was cash market ultra-low sulfur heat minus high sulfur heating oil in New York Harbor. I didn't update the slide, but I provided an arrow to let everybody know that right now there's about a 7.5 cent spread between the two, which come to find out is sort of seasonal for this time of year. When we showed this chart, you and I took guesses on where we thought the spread was going to go. I think you were a little more to the side that it's going to follow the historical patterns. I was more to the side that it was going to maintain a premium. You've proved me wrong so far, but we'll see what happens as we go forward. My question.
I don't think we disagreed that much, did we?
But my question, I think, at the end here is, if we're sitting here in the fall and we've just had this gasoline problem due to lean inventories, as we look at the market structure for distillate, there's no carry in the market for heating oil either. You've commented in Market Watch, and we've commented here that distillate inventories are low heading into the heating season. So I guess the topic that I wanted to discuss is, do you think that we could see heating oil behave kind of like gasoline's behaved at the end of this month? If we get some weather and we get some demand, we're going to see basis, sort of the basis problem, seems like once in a decade phenomena. What's your take on heat basis?
I wouldn't have anticipated that we'd have seen this stubborn refusal in the market structure and the pricing structure to fail to develop the kind of carry market that we would normally have seen, reflective of adequate, more than adequate, maybe inventories going into a heating season. But the fact that we've got Brent, the underlying crude oil, of course, the underlying key crude marker, obviously suffering its own issues with regard to front-end supply. And U.S. heating oil exports still ramped up there, 1 million barrels a day going abroad. Both of those obviously are contributing to the lack of a development of a kind of market which would influence or induce inventory building.
Let me ask you a question. So, I think what you're saying, correct me if I'm wrong, is if the exports weren't leaving the U.S., they'd be backing up and we'd be putting them into storage. There'd be a carry in the market. Why are they leaving? I mean, is there a deficit abroad? aren't the Europeans and other people meeting the need for distillate consumers around the world? Or is the U.S. the supplier right now?
U.S. is a supplier of choice and last resort. Europe, we expected the European refining system to be a lot more productive than it currently is, but in fact, what's happening is the economic conditions there are preventing the development of real good margins that would give the European refineries an incentive to produce. So their shortfall is continuing. Asian demand has been surprisingly strong, even considering the slowdown, and it is Asia where newer refining capacity is coming on stream. The bottom line is the U.S. refining, still with good margins generated by those exports, is cranking away at 88 or 89%.
It's just leaving the country instead of backing up.
It's leaving the country.
Okay, so hopefully for those who are interested in inventories to be built, a carry structure to develop, what we need to see happen is supply for distillate around the world improve and or demand go down, right? And therefore some of the product that our refiners are cranking out will back up on our shores and we can put it into our tanks. In the interim, going into the season, obviously a hot topic is basis protection for our heating oil resellers. And we'd encourage you to call the desk, talk to your sales rep, or call us if you'd like to protect yourself against some sort of basis blowout possibility. So with that, we'll end, and we thank everybody for listening as always. Please let us know if we can do anything better. Thank you.